Good morning, everyone, and welcome to today's webinar. My name is Alex Paul from InvestorStream, and I'll be your host today. Presenting for you today is AXP Energy Managing Director Tim Hart and Chairman Simon Johnson to discuss the company's quarterly activities and other near-term value catalysts. Simon and Tim will give a short presentation on this progress, and both will be on hand to address any questions following the presentation. Please feel free to send in your questions via the chat platform in the question pane in the GoToWebinar control panel, or you can simply email them to me at alex@investorstream.com.au, as many of you have already done so, which is greatly appreciated. You can also download a copy of the presentation by navigating to the handouts pane in the control panel. A copy of the webinar will also be available on AXP's website and social media platforms later today. But for now, I'd like to throw it over to Simon to kick things off for us. Simon, the floor is yours.
Hello everyone, and thanks for joining us today. As Alex mentioned, we've got some slides to share with you as a precursor to the conventional Q&A. But first of all, I'd like to draw your attention to our safe harbour statement. As you know, this is our regular caution that we're going to be making certain forward-looking statements today, and these should not and cannot be relied upon. With that, if we can go to the results highlight slide, please, Alex. So the general theme here is one of continuation of our quarter-on-quarter performance improvement. I won't talk specifically to the figures themselves. They're there before you and are in our releases to the market. But what I would say is that volumes have been down slightly through the quarter, but pricing has improved, and we believe will continue to improve going forward. Tim's going to talk a little bit more in the next couple of slides around some of the themes there. We have drawn down further on our oil inventory, and with the attractive pricing of crude currently in North America, we anticipate making further inroads on reducing that inventory balance as we go forward. Our cash balance is steady, slightly down, and we've seen some significant one-off costs during the quarter, approximately $920,000 US, but these are non-recurring costs and should not be repeated in coming quarters. So I think the general signal that we're sending to the market here is that we continue to make significant inroads in improving the performance of the organisation. We're at the beginning of what we think is going to be a good run in the commodity pricing environment, and Tim and his team are doing a lot to continue to eke out opportunities for enhancing how we produce oil, and also casting an eye increasingly towards how we might expand our total productive capacity. Over to you, Tim.
Thank you, Simon, and thank you, Alex, for the introduction. It's good to be back here on InvestorStream. If you would please advance the slide. So this slide shows a monthly breakdown of our net revenues by commodities, and as you can see, we're showing a fairly consistent and continual upswing, which we're happy to report. However, this result is not quite as good as it should be, as we're dealing with a consistent instability in facilities with our midstream partner, who owns and operates the transportation system and plant. And for clarification, about 80% of our revenue is associated with this system, so it's a pretty big chunk of what we're doing. And just to orient you to the slide, the bottom bar chart represents net revenue, and the top pink curve represents gas production. And if you look at the top pink curve, as you see, every downward spike, it not only has a negative sales implication, but also impacts production in a negative way. And when you're dealing with gas production and gas transportation, when the transport system is down, the pressure builds up in the field and it retards the production, as each of the wells experience an increasing surface pressure pushing back on the formation. And so this has a negative effect not only on the gas and NGL production, but also the oil. And we're working with the midstream partner on improving the overall reliability of the system, and it's of paramount priority for us. So things are progressing in that regard. Next slide, please. So this slide speaks to our production enhancement strategy, which includes exploration. In exploration, our drilling and completions, and it also includes workovers. And so just for a little bit of background, the focus of the legacy MHP folks was it's been largely based on the gas production in the Appalachian Basin. However, with the acreage that MHP had in the Illinois Basin, coupled with the Trey assets and the Kentucky exploration assets, we've got some valuable exploration acreage that are prime oil targets. And so our exploration focus at this time is dominated by our desire to increase our oil production. And the best acreage that we have to do this is in the Illinois Basin, so naturally our drilling program has been focused accordingly. We have 8 well locations identified and many, many more that are potentials. There are hundreds of well locations in the Illinois Basin throughout our acreage that we could drill. And you know, when we turned our in-house geologists loose to go and find oil, they first developed these new drilling locations, but shortly afterwards, they also found a number of locations that were drilled but never completed. And again, they call those DUCs. And as they continued to bring these to our attention, it became clear that we should analyze and prioritize these DUCs accordingly. And that led to a bit of restructuring of our planning. And we're in the midst of completing the first 2 DUCs at this time. There are another 7 DUCs that are being analyzed for the potential of oil production. And in addition to this, we found 2 wells in the Appalachian Basin that have been drilled vertically down to the kickoff point. And these are planned horizontal wells that will deliver significant amounts of gas once completed. Another 10 wells that we've found to have oil production behind pipe. And these are currently gas producing wells that have the capability of being completed in these oil bearing zones and then dual produced. And those are 10 wells that we've found. There are many, many more wells that are just like that we haven't yet run across. And then I might mention that we have 1 well in Colorado that we're intending to perforate in the Greenhorn formation. Greenhorn's a fairly new discovery and has yet to be explored thoroughly, so we're pretty excited about that. From a workover standpoint, we have an additional 104 wells in the Appalachian Basin and approximately 30 wells in the Illinois Basin that are under consideration for workovers. So we have a team of people that constantly are reviewing all of the wells in our asset base for additional production opportunities, and that's how we uncover the 104 wells in the Appalachian Basin and the 30 in the Illinois Basin. And just as a reminder, in 2021, we worked over a new well about every 5 days, and the result was 441 barrels of oil equivalent per day. So the net of it is this: we have a tremendous amount of opportunity here for additional production. Every stone we turn, we find opportunities, and the majority of it is very low cost. So that sort of summarizes our near-term production enhancement strategy, which you'll be hearing more about throughout the quarter. If we just kind of go through what we've been focused on, we've had a tremendous amount of growth, quadruple-digit growth in production and revenue. And there's been a significant consolidation of all of our business units with MHP and Kentucky Exploration and Trey Exploration, and this is no small feat when you're bringing all of the assets under one roof and consolidating resources and leveraging efficiencies and so forth. In addition to this, we've been bringing production online. Many of those MHP wells were offline since being shut in from the beginning of the pandemic, and so so those are some of the wells that we're putting forth some effort. There's been some cost reduction and operational efficiencies as we build out our staff to support our growth. As you might imagine, there were 3 different finance systems that we're bringing in-house. Some of it was outsourced, some of it using contracted accounting professionals. We've built up our human resources areas as we have a need to bring in additional talent to help us achieve our goals. We've added people to land and legal affairs. Also operations, as we limit our outsourced operational activities, and of course the exploration and development that we've talked about today. There is a heavy concentration of internal resources that are running these projects and executing these projects, and where necessary, managing the external contractors that are necessary to do things like fracking and and perforating and things like that. In addition to that, bringing the oil transportation back in-house so that we could have greater control over our inventory and oil sales has paid great dividends for us and allowed us to have greater control over the revenues. We've been working on alternate gas sales opportunities where traditional sales channels aren't available. One such example is that elite site in Colorado, and that Colorado site certainly has taken longer than we had anticipated, and that's very unfortunate, but we're certainly pushing as hard as we can to get that final permit in place. And we've had some recent activity from the regulator in that area that lead me to believe that that permit is imminent and is coming shortly. So we're be anxious to provide additional updates on that as more information materializes. We're exploring other sites in Kentucky. The Colorado site, in my mind, was a prerequisite for moving forward in a meaningful way with our next site. However, it's taken so long that we have started to develop other opportunities that we'll be acting on in Kentucky. And again, these alternative gas sales and power generation channels are a great opportunity, but it's also an emerging market. So we're being careful, and we're looking at each individual site that we set up for proper economics and so forth. And then the other thing that's exciting is the macro picture is extremely strong. Oil and gas prices are strong and continue to have a very favorable market outlook for the foreseeable future. And the same goes for the liquids market. And so a lot of things that are moving in our favor as we execute against our strategy here. And before I turn it back over to Simon, I guess I just want to point out that where we are is not a matter of luck. This is exactly what we set out to do. We said we were going to build a base of assets that are in an oil and gas friendly basin, that are low cost to develop and that already have an existing revenue base, and that's exactly what we've done. And so let me give you some perspective here before I turn over the mic. And that is that, we've been in control of these assets for less than a year. And we've built this for the most part through organic cash flow. Our calendar year revenue in 2020 was $214,000. Think about that for a second. Our calendar year revenue in 2021 was $12.4 million. Think about that for a second. And we still have all this opportunity in front of us. And so these DUCs and these new drills that we're discussing today are really just the beginning. We'll be drilling new wells just like we operate our workover program today, and we have hundreds of potential locations for new drilling. This momentum is just getting started, and it's in its infancy. We'll continue to deploy our strategy and grow this business just like we've been over the last year. And we'll continue to see our revenues increase, our operation become more and more efficient, our asset base continue to grow, and the company continue to prosper. And I know, we've had a lot of questions about stock price and dilution based on the options that were recently exercised, but established 2 years ago when the environment was much different than it is today. And our stock price has fluctuated through all of this, and it will go up and it'll go down. But I'm here to tell you that while this happens, we'll be building a great company here that has a focus on cash flow, margins, employee satisfaction, safety, environmental stewardship, and all the things that make a company great. And that stock price will follow. So mark my words on that. And with that, I'm happy to turn it back over to you, Simon.
Yeah, thank you, Tim. And look, I think just to build on some of the comments in closing there from Tim, I think what he's spoken to is not just about application of effort and executing on declared strategy. We also have a methodology that we actively use across the business as a lens for resource allocation and ranking of opportunities. And here it is on this final slide before you. And we traditionally finish on this just to make sure that you understand, how we think about everyday business decisions and how we think about the business going forward. So we've spent a lot of time in recent quarters, as Tim has mentioned, looking at internal elements of the company and its existing asset base and how that might be improved. But as we bed down the acquisitions, we continue to surveil the market for new opportunities for growth, and we hope to be sharing some of those opportunities with the shareholder base in coming quarters. So with that, Alex, I'll draw our comments to a close and pass the call back to you for the Q&A.
Thanks, Simon. So I'll just, I think we'll address the first question that's come through. We'll address it to Tim. So Tim, it seems that AXP has a lot going on, but perhaps too much going on. Can you discuss the rationale behind working on so many projects at once rather than putting all resources into, say, fixing the downstream issues and getting some big wins more quickly?
Yeah, sure. Thanks for the question, Alex. We feel that we're focusing our resources pretty well, as we've outlined in the presentation that we just went through. We have more bandwidth with an extra board member added to an already active board who are communicating on almost a daily basis. And for reference, this our board is not just a board that meets once a quarter or once a month. It's a very active board, and so there's a tremendous amount of interaction between the folks in the U.S. and the directors, and so that's been extremely helpful. And plus, we're building out the team in Lexington, for example, like I mentioned in the presentation, the finance function, and consolidating that. Bringing in the new assets, particularly the one the size of MHP, was a challenge, but as we said, we're through most of that now, and we're now moving forward. And the downstream issues are not solvable by throwing people at it. It's a question of keeping pressure on our downstream partners to remedy the issues within their control, and where there's a way to independently improve the resilience of the delivery system, find ways to improve redundancy, like examining alternative offtake routes. It's also worth remembering that AXP, like everyone else, has been hampered by the impacts of COVID, and we've had tornadoes hit some of our sites, and now we're seeing some unprecedented weather impact on both of our operations and the gas gathering networks that we sell into. But I know we've got a lot going on, but we've built an infrastructure around ourselves to help support achieving a lot of things. So appreciate the concern, but I think we're doing all right.
Thanks, Tim. So we mentioned briefly in the previous question, and you mentioned I think a little bit in that answer as well, about the downstream issues. Can you just provide any details on what can be done to resolve the downstream issues that you're currently experiencing, and how quickly can those be resolved? And if they are resolved, how much improvement do you think we could see?
Yeah, and we addressed some of this in the previous question, as you mentioned, Alex, but the way our contracts are structured, our partners get paid on volumes delivered. And so we have alignment of purpose in that sense, which is a good thing. And that doesn't mean that we can't see room for improvement in how they're managing elements that are entirely within their control. We do have a constant dialogue with the owners of the gas plant in Rogersville that we send a lot of our gas to, and certainly continue to offer advice and keep pressure on them to improve the reliability of the system. And we also have some people on staff who are intimately involved in the plant's operation. And we do believe there's room for operational improvement. And it's been a collaborative effort, and they're working diligently, and we're providing feedback that's valuable to them on how to resolve some of these issues. And so, my expectations are that things are moving in the right direction. A lot of the current operational issues that we've seen are related to transients in the weather as the temperature has dropped. We're seeing more condensate needing to move through the lines, and in some cases that condensate is freezing. And so, there's certainly a sense of urgency right now because it's cold outside, and so some of the things that they've already deployed, we've seen some improvements for, but I still think we have a ways to go. but I think everything's moving in the right direction.
Thanks, Tim. I'll address the next one to Simon if I can. With the dramatic drop in crypto values, has there been a positive or negative change in interest from miners using AXP?
Well, what I'd say, Alex, is that the nature of the in situ power generation opportunity is that it requires a much longer planning horizon than near-term movements in the crypto values themselves. We aren't presently exposed to the cryptocurrencies, but we do stay informed as to what's happening in the market generally, but more from a supply chain perspective than as an invested party. What affects our customers ultimately affects us too, but it can take quite a bit of time to arrange permits, depending heavily on which state you're in and the disposition of the regulatory bodies we deal with, as people are becoming aware. At the moment, the key equipment required to take a stranded gas well from hookup to generation of electrons is really measured in months. We've been closely engaged with a thought leader in the crypto space now for almost 9 months, and we've developed a very detailed understanding of the operational requirements and probably more importantly of the economics, which bodes well for how this might play out over future locations. So the short answer is we've discerned no change in intent from the mining companies themselves or their intermediaries. This is a new sales channel for AXP, and there remains great excitement across everyone involved in the developing ecosystem, including ourselves. So the miners seem more concerned about the gas price that they're having to pay us now than the cryptocurrency fluctuations, but we see no pullback in the conversations that we're having.
So Simon, as AXP hopefully engages with other crypto miners, can you just give us a bit of an overview of what does the level of work, time and costs look like for AXP? So for example, does AXP create a central hub and feed power lines to the various sites, or will each site be its own complete entity?
Yeah, look, that's a great question. Tim's team have got a whole host of ideas on this front. Most of our focus has been on monetizing stranded gas where the economics don't permit tying that well back into our gathering network due to pipeline or compression capex, et cetera. So there's all sorts of opportunities around daisy chaining several gas wells to allow more intensive mining operations in a single location, which of course results in less ground disturbance, allows you to be more efficient with utility hookup and so on. So yeah, we are looking at different operations beyond what we're doing in Colorado, and suspect that we can deliver a much more I would describe as a more robust solution where we have more intensive in-field activity and optionality around maintenance, well redundancy and so forth. So we haven't looked at running power lines as per the example you mentioned, Alex, but we have looked at how we might deliver the gas in a more optimal manner and to increase the scale of operation. And obviously in Kentucky and surrounding states, we've got a much stronger base of production there. We have established facilities and infrastructure, and we believe that can provide an important measure of stability to what we offer our crypto mining clients on site.
Thanks, Simon. Now, on a bit of a corporate level, now that the company is making a considerable profit, would the company consider a buyback of shares to decrease the shares and offset the options that recently hit?
Yeah, I think on the previous webinar, we said that we have no immediate plans to do a buyback or a share consolidation, and that remains our position right now. We feel that we can make better use of our cash at the operational level. We're only just getting to the point now where organic cash flow is healthy. Tim's shared, the improvements that we've yielded to date, but we're still in the improvement mode. So we recognise the value of mechanisms like buybacks to reward investors, and we definitely want to get the share price well above where it's languishing presently. But not all investors are necessarily supportive of a strategy of returning cash to shareholders. So we continue to see great opportunities in the industry. The integration of MHP, the Kentucky JV, the Tray acquisition, that's just starting to pay dividends, as shown by Tim in the slides that we shared with you and the financials that we're starting to deliver to the market. So, we don't have excess capital that we can't find a use for at a company level. In fact, if anything, we have a portfolio of opportunities to further grow the company. So I think at the moment that remains our best use of cash, but we are actively listening to suggestions like this from the shareholders, and we'll continue to sort of bake that into our thinking.
Thanks, Simon. I'll just address the next one to Tim as well. Tim, is there a timeline for Colorado Bitcoin starting, or indeed Kentucky Bitcoin starting? Can you give us a bit of an update on the timeline there?
Well, as I've mentioned previously, and please know that no one's more aware than me on how disappointing the delays have been. Unfortunately, we really don't have visibility on when we'll get the green light, but we do know that we're down to the last few items, and we are waiting to hear the final verdict from the regulator. We have done everything that we can to progress things, and it's in their hands. But our excitement about this new type of operation remains, but we're increasingly looking to locations where we have more supportive environment or more operational synergies to leverage, as as the first site in Colorado has been quite a challenge. Recent communications with the regulator seem to point that the permit is certainly imminent, but my anticipation of the timing would really be a guess, and quite frankly, I've guessed wrong too many times for this for me to do it again.
Thanks, Tim. I'll just go back to Simon on this one. Again, going back onto Elite Mining, can you just give us an update on what the current status is of the Elite Mining permitting in Colorado? And do you have any estimates on when approval will be received? And is there reason to be concerned that approvals will not be granted?
Yeah, look, I just repeat Tim's cautionary tale on making predictions. We've been thinking that approval for the final round of permits has been imminent for some time, and that hasn't been the case. But what I want to really stress here is that we're committed to this sector. Yes, it's been slower than we hoped for in terms of bringing our first site online, but we have to operate within the regulatory guidelines and channels, which we respect. But as an energy partner to the sector, we see it as a great sales channel going forward, and we're going to continue to develop it. But we're certainly a little leery of expanding our operation in Colorado beyond the existing footprint.
Thanks, Simon. Now, Tim, on the OTC, the half-penny share price and 6 billion outstanding shares is not a good look, and I think some investors are sort of worried that the perception will be that many will see this as just another bloated OTC company that is diluting the company into the abyss. Now, obviously, a lot of the investors don't see that, but that could be a potential perception problem for the company going forward. How does the company plan to address it?
So the shares on issue are a function of the past, unfortunately. The company's been operating previously as an explorer driven by regular fundraising from investors. We have spent the last 12 to 18 months pivoting to a production-oriented operator that generates its own revenue and is more resilient against the changing stakeholder sentiment towards conventional energy companies. And you're starting to see this in the revenue that we're generating, especially with current oil and gas prices. And so we're keenly aware of the requirement to improve the share price, but none of the options that we have exist in isolation. For example, the capital required to finance a material buyback would really place pressure on our cash position. And we think that the best approach, as Simon mentioned, is to continue running the company well, incrementally improving our operations. And as I said, this will take time, but will also reward our patient investors. And we understand these concerns about the capital structure and why there are a lot of shares on issue. Our focus is really on improving performance to rebuild the healthy support that we experienced in the latter half of 2021. Like the OTC, there are many small ASX companies that have similar capital structures, but you're right in your assessment with our underlying revenue streams and the growth that we're delivering to the top line. We're not just another OTC play. If there's any question about that, then I would say, stay tuned, continue to watch us.
Thanks, Tim. So we've had a number of these questions come through, and it concerns dilution. I think a lot of investors are worried that the company is diluting. Can you just sort of confirm or clarify whether the company is diluting? And if not, are there still old note holders or other investors that are selling shares at a fraction of a penny?
Well, we know that the dilutionary effect of the recent option issuance has caused consternation. However, these options were agreed to almost 2 years ago as part of the plan to rescue the company from the perilous position that it was in at the time. A huge amount of work has been undertaken to turn the business around since then, both in terms of making some decisions, changing strategy, undertaking some excellent acquisitions, and getting us to a point where we can look at opportunities for further growth rather than just survival. I guess one of the things is I'm a significant shareholder as well, and so I feel the same impact, that the other shareholders feel when there's a dilutionary effect on the equity base. And as we've said, it's only now that we're getting to a position with the balance sheet that we can look at debt options. And that doesn't mean that we can entirely disregard the equity side, but our focus is certainly on exploring debt finance where it's available on acceptable terms. So, our business is changing. If you look at where we came from, you might be able to piece the picture together as to why the share structure is where it's at. But I would invite people to look at the not too distant past to predict our performance in the future.
Thanks, Tim. Now, I guess, Simon, on a similar level, it appears that there may have been a request to raise the authorised shares to 11 billion, which, again, for current and potential investors, it screams stay away. Now, there are also comments floating around about the needing the flexibility for acquisitions, etc. But we've already touched on the record profits, the low debt, and again, we're talking about other financing options available other than further dilutionary mechanisms, as Tim's mentioned. Can you address why specifically the company feels another 5 billion shares might be needed, and can you just I guess follow on from what Tim's saying, address investor concerns around the share structure?
Yeah, okay, thanks, Alex. Thanks for the question. Look, at the AGM, there was a resolution to increase our placement capacity by 10%. And this is a standard resolution that many ASX companies seek every year. This does not mean that a placement is pending or that we're considering issuing these shares. It just simply means that we have prior shareholder approval to do so in the event that we need to raise capital for something like a strategic acquisition, for example. What I would say is that AXP has not undertaken a placement since December 2020. So that's some time in the past now, and we've had shareholders convert options since that time, but we've not raised capital, and we have developed a good cash balance due to our productive growth. From what I can see, this is probably one of the longest periods in the last 5 years where the company hasn't needed to raise capital. So you can see that the current board and management team has the same philosophy to dilution, and I think Tim spoke well to this this general issue in the previous question. We're not looking to print a whole bunch of more shares. We're looking to run the company within the confines that we've set strategy-wise, and we're looking for opportunities to grow the company further. How we finance that, we'll have to look at when we get to that point when we have something in our sights. But as Tim said, I would just echo his comments. The way that we're hoping to do that is increasingly through debt finance and conventional sources of finance, not by printing more shares.
Thanks, Simon. Now, Tim, we'll go back to the operational aspect of the company now. Can oil production be ramped up to cash in on the high oil price?
I see this question in two parts, Alex. We're definitely incentivized to sell as much oil as we can, but we also need to protect the life cycle of the well, and rapidly increasing production isn't a sustainable option. More wells have been ruined by overproduction than anything else, and so you want to balance how fast you pump the well and how quickly you remove the oil from the wellbore with the longevity of the well. the other part of it is selling down the inventory, and the challenge that we have in selling down the inventory coming into the North American winter is that these tank batteries and stuff are located in mountainous locations, and so there are a lot of times when we send a truck out to empty a tank, we have to accompany that truck with a bulldozer, so that the bulldozer can pull that truck up to the tank and do its work, and then leave. So that is more of a challenge in the winter time. So so while these things are possible, I see this quarter and a significant oil sell down as a bit of a challenge due to the winter conditions. And we want to be careful about how fast we produce oil from our wells.
Thanks, Tim. So what is the realistic timing for the DJ Basin permit to start crypto mining and oil production?
Boy, Alex, I think we've answered that in previous questions.
Okay, Tim. So can you just going back to the corporate side of things now? Can you just elaborate on what caused the delay of the listing to the OTC QB?
Sure. So we had some administrative delays, and unfortunately now we're in a bit of a holding pattern until we have the required stability and threshold in our share trading. The timing of the option issuance wasn't ideal for the short-term share price support. But that was determined by the events that took place almost 2 years back, as we discussed prior. So, as we continue to deliver good results to the market, the share price will respond. We'll be in a position to finalize our uplisting with the OTC in short order, I'm sure. That's the primary challenge. The application and everything, all the paperwork has been completed. We're just waiting for that share price to recover a bit.
Thanks, Tim. Now, I guess going back to the performance of the stock within the last 6 months, specifically given the positive news of revenue growth and newly added revenue stream with Elite Mining, yet the stock price continues to break down. Could you just provide us with a bit of an overview of what leadership's plan is to improve the stock's performance and gain shareholder confidence once again?
Yeah, I think in general, Alex, it's to continue to put wins on the board that are evident to the shareholders. I would venture to say that if the shareholders go through our financials and they look quarter by quarter, they would be relatively content about our upward momentum and our direction and our strategy as we've put forth. So continuing to manage the company in that way, I think, is the secret sauce. Like I mentioned in the presentation that we went through, we're going to continue to build the company and operate the company in a way that builds margins and builds cash flow and increases revenue and everything that we need to do in order to build a great company, and that stock price will follow, and I stand by that. And as I said, continue to watch. You'll see it. It'll change.
Now, Tim, obviously the company's put out an announcement today. You've kicked off your drill program and field development program as well. Can you just give us a little bit more color on these DUCs and what could they deliver?
Well, the DUCs are a great low-cost opportunity to quickly add to production. And, they're essentially like bringing new wells online that have never produced oil and gas. They were drilled, cased, and never completed. In today's money to get to this stage, you're looking at, up to, hundreds of thousands of dollars per well. So there's a lot of sunk costs here and that we're capitalizing on. Something that, that we're not in the habit of doing in this sector is predicting a flow rate before wells are brought online. That's a really difficult in a tall order that you sort of set yourself up for failure if you do that too many times. But With the first two, as we've stated today, they're flowing on their own, which is a really good sign. It's early, but but to have a well flow back on its own pressure is a really good sign. And the fracs are the key to the good flow rates, though, and those fracs are one of them is going to happen next week, and the other one shortly thereafter. And so, we'll frac them back to back, and then we'll report any gains that materialize. That way I can talk about real data rather than speculation.
Thanks, Tim. Can you also tell us a little bit about the Daisy drill target and that geology field?
It's an existing target, in a field where we've got existing operations, and so that certainly helps tremendously. There's nothing like drilling for oil in an oil field. It's a low cost, low risk vertical well that has great offset support from our competitors nearby. There have been a few operators that have done some drilling next to our Daisy lease that have had some real success in one of the formations that wasn't a primary target in the past on that lease, and so I feel like there's a really good chance that we're sitting on another whole formation in the Daisy lease that's really never been interrogated. So I'm pretty anxious for the result of that.
So can you give us a little bit more detail on these 7 other ducts, and when will you look to complete them? And I guess also with regard to the time frame, will you start them while you're drilling Daisy if the other wells come in and deliver?
So they're a mix of mainly gas and some are primarily oil targets, and both gas prices and WTI prices tracking well, but oil is definitely our current focus, and so we're looking at those ducts that we have, the 7 ducts that we've identified for oil potential, and if our geologists come back and say that that the oil potential is not as significant, then it's likely that we may move on and continue our drilling program. But I mean, the good part about having so many options, and that's what I sort of tried to outline in the presentation, is that you can make decisions based on the results of your last workover or your last new drill or your last duct that's been completed, and that's what we really intend to do. If we see that these 2 ducts that we're over top of right now are producing in those zones, I'm going to pivot and put the geologist on other locations that are there, and if it's really good, then we may focus our efforts on drilling in those areas. So our field development is a bit fluid, and with any good developer, you base your decisions on what you know. So I guess the short answer is those ducts may be the best opportunity that we have right now. They're certainly there's no question that they're all going to be producers. Every one of them is going to be a good producer. They're in fields and areas that we know. I'm targeting oil at the moment, and so that's we're going to go after what'll give us the best result for oil production.
Thanks, Tim. We've got a couple more questions to get through, and then we'll leave it there. But Tim, your last quarter showed some decent top line growth, a lot of which can be put down to the price of oil and gas. But your cost base seems stubbornly high, and we've just had 2 quarters of some big one-offs. Realistically, when do you see more of this revenue dropping to the bottom line, and how can you more aggressively tackle the cost base?
So as discussed, we're addressing costs. We still have legacy payments that we're wearing from the Colorado drilling program, which we plan to offset when operations ramp up with Elite. But let's get this in context. We've operated what was MHP for only 3 full quarters only, and there needs to be a balance between managing the cost base but also investing in the business to really drive revenue to much higher levels. And as we've said, we're just touching the size with identifying production opportunities. The 9 ducts is another example of the gems we continue to uncover. And so, the point here is we're not here just to trot out $5 million of revenue a month. We're we're a lot more ambitious than that, and we have the suite of assets to build a much larger and reliable revenue base with healthy margins. And so it shouldn't be lost on our shareholders that we're very disciplined with capital allocation, and you will continue to see this.
Thanks, Tim. I'll just bring Simon in for the last couple of questions. Simon, can you just, firstly, is the fossil fuel sentiment having an effect on the share price? And I guess more broadly, can you just talk about the current market sentiment towards fossil fuels?
Yeah, sure, Alex. Look, I think with this whole issue of there being some kind of permanent and immediate decline in people's appetite for hydrocarbons, I think that's been completely overblown. I think energy demand's a function principally of GDP and population growth. And if you look back at the last 20, 30 years, it's increased consistently through time, and it's an inexorable trend line if you look at the data. So in my opinion, the energy transition, the term that people are using, is better expressed as an energy addition. I think we may be at the beginning of an excellent run in the oil and gas prices. Goldman Sachs, for one, are forecasting a super cycle. I think you've seen sustained underinvestment over many, many years now, which bodes well for any oil and gas company that remains in the space, and definitely for AXP. Headwinds are definitely being posed by policymakers and pressure groups, but this idea of renewable supply displacing traditional energy sources, such as we generate at AXP, that's not happening in my lifetime. It can take 6 to 10 years to permit a wind farm. We can't bring enough renewable capacity on board fast enough to meaningfully displace large-scale oil and gas production from the supply mix. It just simply isn't going to happen. We don't have enough energy. Everyone is going to have to add capacity to the system, including oil and gas companies. So whilst I think, the main response required of us in this climate is that we definitely need to do more to improve our emissions footprint. Regulatory oversight is definitely increasing, but this is a response really to community expectations. We have to address them. It's just going to be part of the cost of doing business for us. But I think on the output side, there is a very, very positive opportunity for us to continue to reticulate our gas and oil to market and to receive increasingly better terms of trade for them. So it's getting more complex and more difficult, but I think potentially we're on the cusp of a time where we can actually make tremendously more profits than what we've seen over the last 5 to 6 years.
Now, Simon, we've talked about quite extensively the company's strong operational performance versus the share price and how things seem a little bit out of whack. I guess the first question is, in your opinion, is the AXP share price undervalued? I think I know the answer to that one. But what can be done to bring the share price back up to levels consistent with the company's strong operational performance?
Yeah, well, I definitely think it's undervalued. I think as we've spoken to today, there have been a number of near-term events, principally the option issuance, which perhaps some shareholders hadn't factored into expectations. That has disappointed and placed downward pressure on the price. But as Tim has said, and I would reiterate, I think the business is continuing to run better and better. We're starting to deliver on the strategy that we talked about 6-9 months ago with the integration of the assets that we acquired. We're just starting to pay dividends there. So I think people need to look through the short-term noise around share price signals and people getting in and out of the stock, day traders and the like, and need to look at the heart of the business. And we believe that it's incredibly healthy, that there's great opportunities for further expansion. We're continuing to improve profitability. When you think of the crisis that the company was in just some sort of 18, 24 months ago and where it is today, there's been a dramatic and sustained improvement. So Tim and the guys are delivering on strategy, and that's starting to flow through to the bottom line, as you're starting to see in the quarterly results. So I think it's just a question of educating people about the changing nature of our business, continuing to keep the market updated as we have successes or setbacks for that matter. And I think that you will see through time people come to understand the story more, for our financials to steadily improve. and for that to be a good story for investors, and that will get investors who understand what we're doing and are willing to stay in for a longer term ride in order to enjoy the successes of that. As I say, that the macro signals are very, very good for the business right now. So we think people just need to be patient, let us deliver on what we say that we're doing, and mark us against that, as opposed to short-term concerns about share price performance on a daily basis.
Thanks, Simon. Look, I think that's probably the best spot to leave it there. That's all the time we have today. Thank you all for joining me, and I'll also like to thank both Simon and Tim for presenting and taking the time to answer some questions. I just want to obviously point out the fact that the level of engagement among the audience is quite pleasing. We had a number of high-level questions that we didn't get to. We were inundated with questions today, so apologies if we didn't manage to get to your question. But again, it shows a high level of engagement among the AXP shareholder base. Now, as I mentioned before, a recording of the webinar will be on AXP's website and social media platforms later today. Before I let you go, Simon, do you have any final comments to leave with us today?
No, I don't think so. I would echo your comments, though, Alex. It is great to see an active and involved investor base. We do listen to what people say to us. Where there's active discussions at the conclusion of every one of these webinars by the management team and the board. So, I mean, the interest and the suggestions and the questions does actively contribute to our decision making. We're very pleased with how the company's operating at the moment. We've got most of the integration of these acquisitions behind us. We're starting to look out for new opportunities, and we just really would ask people to, stay the course. We're starting to deliver, and we think that the next couple of quarters are going to produce some significant results.
Thanks, Simon. Tim, before we let you go, anything to add?
I think Simon summed it up perfectly. I am extremely excited, more so than I've ever been, about the direction that we're heading in. Also, the opportunity that we've got in front of us, and so I would echo Simon's comments about just be a little patient and continue to watch what we're delivering, because we have plans to do just that, and we've got a whole bunch of things in store for the company on a go forward. So. I too appreciate the shareholder participation. Thanks to everybody who has helped make this happen, and it's been great to update everyone.
Fantastic. Well, that wraps it up for us here. Thank you, everyone, and all the best.